So if you're looking to stay in a home for a short period of time, you would definitely not want to stay in a home because there's a lot of holding costs, there's a lot of costs for selling your home, 6% commission for your real estate agents, you've got costs, title costs, prorated taxes that you have to pay. It just doesn't make a whole lot of sense to stay in a home probably less than about 2.5 years. If you're going to stay in your home about 3 years or more, you're probably going to break even or make some money on that home.
Cool. That's straight to the point. I love it. So if you are someone living in an apartment right now, then you're saying it's best to stay in the apartment because of any kind of market shifts? Is there anything coming down the pipeline that we should know about?
Well, Mr. Trump is trying to push the rates down. You hear all these marketing ploys by the Fed saying they're dropping rates, which they are. It takes a little bit of time. When the Fed states that they're going to drop rates by 0.25%, that doesn't mean it's going to happen tomorrow or today. It means it's going to happen over several months. And what that means is when they drop the rates, they're trying to stimulate the economy to keep us out of a recession, even though we're on the verge of a little bit of a recession. Now, I don't think it's going to be a bad recession, but I don't think this would be, again, if you're not going to stay in a home for probably about 5 to 10 years, I would say more like actually 7 to 10 years, I wouldn't buy a home. Lots of different programs out there. You hear Fannie Mae, you hear Freddie Mac, you hear FHA, you hear VA, USDA. What is Fannie and Freddie? It's a conventional loan. Now, why the difference? Why Fannie, why Freddie? They have different parameters and different rules that each one play by. That's your traditional, been seasoned, has a lot of money to put down borrower that has great credit and good income. But they also have first-time home buyer programs as well that most people don't know about. Depending on your income level, you may qualify for an even lower interest rate or a lower PMI than most people that put 5 or 3% down. But going into like FHA and VA and USDA, what are those loans? USDA, it's a rural loan. So anything pretty much on the outskirts of DFW or outskirts of Houston or Austin or San Antonio or any big city, those are typically USDA territory. So that's 0% down. Now they do have a funding fee. 0% down, just like VA. Now, if you're not a veteran, USDA may be the way to go. You just have to drive a little further into work. But as far as your zero down loans, those two are kind of your front runners as far as the horses go. But there are down payment assistance programs for FHA, for conventional, for VA, for USDA as well, that are grant programs, and they're also bond programs. So the difference is, a bond program, you actually have to pay that money back. A grant program like T-Shack in Texas is free money. That's 3%, 4%, 5%, depending on the program. Here you go. As long as you make 6 payments, free money. That's a win.
Okay, so you mentioned all sorts of different loan products, and then based on the person, any one of these loans could be great for very different people. Mm-hmm. And so let's just start off with the number one most asked question for me was like, how do I get a super low down payment on a loan? And if I have horrible credit and if it's my first time, let's talk about the FHA loan. So okay. What is it? What does it stand for? How is it funded? What are the rates for it? How much do you have to put down? And then just things you got to know about the FHA loans product specifically.
Well, FHA, it stands for Federal Housing Administration. So it's a government-backed loan. The reason you pay the monthly PMI, which I'm sure you've all heard of what that is, you don't know exactly what it is. It's an insurance policy. If for some reason you do default on your loan, then that insurance policy, aka the government, makes the bank whole. Now, another, the parameters of FHA and the actual details of it, as far as the loan itself, there's a 1.75% funding fee. What that means is if you have a loan amount of $100,000, there's going to be another $1,750 that's built into that loan that is going to, you don't have to come out of pocket, but it's going to be, you have to pay it back. I mean, that's all there is to it. But FHA is a great tool for clients that have 550 or better credit score. Now, if you've got a 550 credit score and you're looking at the interest rates, your interest rates are going to be higher. They're going to be in the mid to high fives. You'll probably have to pay a little bit more for it. You have to put 10% down when you're below 580. So if you've got a 580 credit score or better, then you're going to be, at looking like a 3.5% down payment. As long as your debt to income ratio is, right around 50%. You should be good there. And then as far as the closing costs, you're probably looking at, depending on your price range, but I always like to look at maybe like 3.5%, anywhere between 2.5% and 3.5%. But again, your lending professional will be able to give you that information.
Okay, before we move on to the next loan product, you mentioned something called debt to income ratio. What does that mean?
So what that means is if I make $120,000 a year, I have a $10,000 a month before tax salary. So you take 10 grand and that's your base income. You take all of your monthly debts. Let's say you have monthly debts of $5,000. 5,000 divided by 10,000 of your income, that means that you're at a 50% debt to income ratio. You're probably not going to be able to buy a home in that case. But if you have, let's say $500 car payment, another $500 car payment for your wife, and then $250 in student loans, then you're at $1,250. So right now you're at a 12.5% debt to income ratio, which means that you have another $3,750 that you can pay for a mortgage in order to qualify. As far as pre-approval versus pre-qualification, you've heard the terms. What's the difference? Pre-qualification, you've called somebody, they've pulled your credit, they've asked you some information about your income, and they've asked you some information about your down payment. You tell them that information, you haven't given them a shred of evidence, and basically that's a pre-qualification. In my opinion, I would suggest calling a loan officer who has been doing this quite a while and has a lot of experience in the industry. And they will ask you for your income documentation, where your down payment is coming from, whether it's a gift, whether it's money you've saved up, or if it's a down payment assistance program. Again, we can get into that in further videos when we talk about different programs that you may or may not qualify for. But as far as the pre-approval process is concerned, definitely get with a loan officer that knows exactly what they're doing so they can gather all your documentation properly, put it through the automated underwriting system, and make sure that when they do send a real estate agent the pre-approval letter, that it's gold and not something that you can wipe your you-know-what with. But that's my personal opinion. Pre-approval is the way to go.
So for me, I know anyone that's like a transaction beast that's trying to get as many sales and people helped as possible. I don't waste my time. I don't ever go out and show anybody homes unless I actually get a verified pre-approval letter from the lender. And then that saves me a lot of time as a real estate agent because I can't even submit offers to sellers unless I put with the offer the pre-approval letter. And so if you're even serious about doing this, if you want to go out and kick tires, go kick tires. It's cool. Go check out open houses, get familiar with the area. But if you get serious about this and you really want to see what you can pre-qualify for, pre-approve, get yourself pre-approved for, then that is the first step, talking to a lender and getting yourself pre-approved. Now, I have a question for you. Now, say, for instance, I am a college kid or I'm a waiter and I'm just now starting to get my money saved, or I'm making minimum wage or something like that, and I happen to have 500, 550 credit score, and I know I have a lot of credit card debt, student loan debt, all stuff like that. Like, man, I watch Sean Ray Realty. Make sure to like and subscribe. Make sure to hit the notification bell. I watch all of his videos. I'm inspired, and I want to get into investing. But there's just no way. Like, I would not get pre-approved for like anything. So should those people just wait and save and work on their credit, or do they have any kind of hope? Would there be any kind of like growth from talking to you?
Absolutely. Should they just go in and put an offer out there on a house? No. Should they talk to a professional like myself? Absolutely. Because if you don't have the roadmap, you're just kind of walking around in circles. So what's the point of that? You want to go in, you want to invest, you want to not waste money, you want to not throw money at the landlord and just throw money away. If you pay $1,000 in rent a month, that's $12,000 a year. If you do that for 10 years, that's $120,000. That's a stupid amount of money just to give to someone else. I'm a landlord, and I don't mind taking that money, but I would rather help our population purchase a home because I'm so passionate about it. I love when you get a first-time home buyer or somebody who thought they couldn't buy a home. You work with them, you get them on that map and on that road to purchasing a home so that they have that big smile on the face, when they're at the closing table. It's the best thing in the world.
So, in summary, if you want to start buying a house, first thing you need to do is reach out to a lender, get yourself pre-approved, and see how much you can qualify for. Then, from that point, we go out and we start submitting offers, looking at homes, and seeing exactly what fits your needs for your investment or your personal purchase. If you don't think that you could get pre-approved for next to nothing, it's okay. Still reach out to a lender because he can advise you on exactly what to do step by step to get you to the results that you're trying to get. Thank you again for watching. We have a whole video series about what to do as far as loans are concerned with Mr. Derek here. Make sure to check him out, and also thank you guys so much for watching. I'll see you in the next video.